This is no longer an overheated economy.
Fed Chair Jerome Powell faces Congress and investors are closely listening. I'm Lisa Bernhard with Reuters, and joining me today is Sam Stovall of CFRA Research. Sam, okay, Jerome Powell today is making his semi-annual appearance in front of the Senate Banking Committee, and he said, quote, "Today I'm not going to be sending any signals about the timing of any future actions," meaning rate cuts, of course. But did he telegraph any clues at all?
I think he did, Lisa. I think he said that the U.S. economy is no longer overheated. The labor market is in balance, and a further softening of the overall economy and the labor market could be reason to cut rates. He didn't say in July, he didn't say September or December, but in response, the CME Fed Watch tool now shows a 73% likelihood of a rate cut in September.
Okay, but many analysts in the past have told me that the Fed may have resigned itself to putting the economy into a recession if it got inflation close to that 2% annual target rate. Today, Powell said, quote, "Leaving policy too tight for too long could unduly weaken economic activity and employment." So is the central bank now really trying to avoid a recession, kind of changing its tune a little bit in what it's indicated in its sort of prior messaging?
Well, I think they're saying so far so good that even though historically a rate tightening cycle typically triggered an inverted yield curve, led to the contraction of leading economic indicators and helped the PMI data dip below the contractionary level, all of which then preceded recessions. This time around, we're finding that even though we've had this inverted yield curve for now 2 years, the economy remains resilient, and the unemployment rate even now is at only 4.1%, which is well below the 5% threshold that many economists had previously thought represented full employment.
You think we're completely in the clear of a recession? What do you think?
Yeah, right now we expect the U.S. economy to grow by about 2.5% in 2024, dip to about 2 to 2.1% in 2025. We are not currently forecasting a recession.
Okay, so tomorrow Powell speaks in front of the House of Representatives, so we'll be watching that, of course. And then later this week, we get the Consumer Price Index and the Producer Price Index, and those will be the latest readings on inflation, which, of course, will be key. What are you expecting to see?
Well, I think we'll first see optimism and then a little bit of pessimism. By that, I mean that the headline CPI should show a slight month-on-month and year-on-year increase, but investors will probably focus more on the decline in the year-on-year core rate to 3.1% from 3.3%. So that's the positive. The negative is that we could see all four producer price index measures, meaning the month-on-month, the year-on-year for headline, as well as the month-on-month and year-on-year for core, all of which should show minor increases. But the PPI, I think, is the least influential of the three inflation measures. The most important one will come later in the month, which we think will end up this being the PCE, personal consumption expenditure measure, which should show flat to lower readings.
Stocks were mixed when Powell was speaking. The main indexes are up across the board right now, a few hours before the market close, and the yield on the 10-year Treasury rose. So what do you make of the market's reaction?
Well, interesting. You would think that the 10-year yield would have declined. Also, you would have expected the small cap benchmark, the Russell 2000, to have risen. But in fact, both of them went in the opposite direction. I think that implies that investors are pretending to be from Missouri and saying, I'm going to wait. You have to show me that this is going to happen, and that the Fed would rather err to the side of keeping rates high for longer rather than easing too early, because they're reminded by the seesaw monetary program that occurred in the late 1970s that allowed inflation to remain stubbornly elevated.